Good day everyone, thanks for joining me. My name is Matt, I'm the IT and Comms Analyst, and I'm going to take you through our latest EIA report on Accenture, which covers the third quarter results for 2021. In this presentation, I'll briefly discuss the results. They were very good, they beat expectations, and from the top to the bottom of the income statement, they saw growth of approximately 20 to 26%, although it was off a depressed base. I'll go through our valuation of Accenture and discuss why we're changing our call to underweight. Essentially, it's due to the high valuation multiples, a derating to its average multiple, which is more probable than realizing further upside, given that it's trading at all-time highs and growth is expected to revert back to its average. And history has shown that returns from current valuations have been low to negative. Looking at the results, revenue was up 21% to $13.3 billion. Gross profit was up 25% to $4.4 billion, which represents a gross margin that accelerated, and that was about 33%. Net income and earnings per share were up 26% each, and the dividend was increased by 10% to 88 cents a share. The market was perhaps a little bit pessimistic on consulting, but these results beat expectations, demonstrating the resiliency and defensiveness of Accenture. The results were received positively by the market. In pre-market trading, shares were up 4.3% and closed on the day up 2%. Since our last recommendation in November 2020, which was a neutral call, Accenture's performed pretty much in line with the market. Over a one-year basis, it's also performed in line with the market. Looking at the assessment, the results were pretty good. However, the growth rates were elevated as a result of the depressed base, and revenues are expected to return to long-term averages of single digits. The margins remain stable and increasing, and the company has a great free cash flow generation. It has a solid, stable outlook, and it's a great defensive company which is diverse across geographies and industries. However, the valuations are currently very high, which forces us to ask ourselves, can the growth justify the current multiples? And we think not. The consulting model is not scalable and relies on acquisitions for growth. In our multiples-based method, which is supported by our reverse DCF, indicates that it is currently more than fully priced. And if you look at the graph on this slide, history also suggests that returns from these levels are quite poor. So we really like Accenture, but not at these multiples, and we are therefore downgrading our recommendation to underweight. If you'd like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, the report on Accenture can be found on MyBase. Thanks for tuning in. Please take note of the following disclaimer before I end off.